Have you ever noticed how we humans just can't resist trying to predict the future?
Yeah, like it's this deep-seated need to know what's coming next.
Totally. And it seems like nowhere is that more true than when it comes to the markets, right?
Oh, absolutely. I mean, even with all the sophisticated tools and real-time data we have today, we're still kind of obsessed with trying to figure out what's going to happen next.
It's like we're hardwired to search for those clues, those little
Totally.
hints about where things are headed.
Yeah. And that fascination, well, it goes way back.
Oh, for sure. Long before algorithms and high-frequency trading, there were folks trying to make sense of the ups and downs of the economy.
Right, and one of those people, a guy named Samuel Benner, well, he was a farmer from Ohio back in the 19th century. He caught my attention because he was looking at these patterns, these long cycles.
Yeah, interesting. A farmer, huh? So not a Wall Street financier or anything.
Nope, just a guy watching the seasons change, observing the rhythms of nature, and somehow he started to see those same rhythms playing out in the economy.
Okay, I'm intrigued. So what did this farmer turned market watcher come up with?
Well, back in 1875, he actually published a book. It was called Benner's Prophecies, Future Ups and Down in Prices.
Benner's Prophecies. That's quite a title.
It is, right. And the really wild part is that when you look back at some of his long-term forecasts, they're surprisingly accurate, even after, almost 150 years.
Okay, color me curious. So let's get to the heart of it. What exactly is this Benner cycle he proposed?
All right, so the Benner cycle. Basically, it's a long-term model that tries to forecast the general direction of business and commodity prices. And his central idea was this. He thought human psychology plays a huge role in shaping these predictable, albeit very long-term economic cycles.
So he's saying that our emotions, our feelings of optimism or pessimism, they're not just random noise. They actually drive these patterns.
Exactly. And it's kind of insightful because even way back then, without all the data and fancy tools we have today, he recognized that market sentiment, how people are feeling about the economy, it can become a self-fulfilling prophecy.
Right. So if enough people start to worry about a downturn, well, that worry itself can actually trigger the downturn.
Exactly. And what Benner was trying to do was provide a framework to help people understand these recurring phases, these swings between optimism and pessimism, so they can make smarter investment decisions.
So like recognizing when to sell, when optimism is pushing prices up, and when to buy when everyone's feeling gloomy.
Yeah, it's the classic buy low, sell high approach, but viewed through this lens of these long-term emotional waves.
Okay, I'm starting to see the big picture here.
Yeah.
But let's break it down a little bit further. So Benner identified 3 key phases in this cycle: panic, good times, and hard times.
Right.
Let's start with panic. What exactly did he mean by that?
So for Benner, panic happens after years of what he called irrational buying or selling. It's basically when things get a little or a lot out of hand and you reach these unsustainable peaks in prices.
Kind of like a bubble, right?
Yeah, exactly. And then, of course, what goes up must come down, so you have these sudden dramatic falls in prices, which then fuels even more panic. It's this vicious cycle.
We've seen this play out time and time again, haven't we? I
Yeah.
mean, think about the dot-com bubble or the housing crisis.
Absolutely. And Benner actually represented these cycles visually in his work with these, rising and falling lines on a chart. And the panic periods, they were always depicted as these really sharp, rapid drops. It really emphasizes just how volatile things can get.
It's like that feeling of a roller coaster dropping suddenly. Right.
Yeah.
Okay, so we've got panic. What comes next?
After panic, you get the good times. And that's pretty much what it sounds like. It's a period of generally high prices across the board in various markets. And Benner's advice during these good times was to use it as an opportunity to sell investments and take profits.
Interesting. So don't get too caught up in the euphoria of the moment.
Right. Because remember, those high prices, well, they're often built on that widespread optimism, which, as we know, can be fleeting. It's all about recognizing that every boom eventually leads to some kind of correction.
So panic, then good times. What about hard times? It doesn't sound very cheery.
No, not really. But it's an essential part of the cycle. So hard times, these are the years that follow those excesses of the good times and subsequent panic. We're talking recessions, maybe even depressions.
Those periods where the economy really contracts.
Exactly. And during these hard times, market and asset prices, they're typically pretty low. And Benner, his view is that this is actually the ideal time to buy and hold quality investments. Basically, position yourself for the eventual rebound.
So the entire cycle hinges on this ebb and flow of market sentiment, driving prices up and then back down, creating these recurring opportunities if you can just keep your head about you and recognize the patterns.
That's the idea.
It's amazing to me that he was trying to systematize all of this back in the 19th century, without the data and the complex models we have today.
I know. And what's even more amazing is that his forecasts have aligned pretty well with some major historical events.
Let's dive into that. You mentioned earlier that some of his predictions turned out to be surprisingly accurate.
Right, let's start with the Great Depression. We're talking 1929 to 1941. So Benner, he had actually indicated good times in the years leading up to it with a panic around 1927, and he even predicted the bottom of the hard times around 1942.
Wow, so he saw the crash coming.
Well, the stock market crash happened in 29, and then the recovery really began around World War II, 1941. So, the timing wasn't exact, but his cycle definitely pointed toward a major downturn and then a pretty prolonged period of economic trouble in that time frame.
That's a pretty remarkable prediction considering he was writing decades earlier.
It really is. And what's interesting is he was right there in the thick of it. Like, he lived through those hard times he was talking about.
Okay, so he saw the Great Depression coming. What about other major events like the oil crisis of 1973? Did his cycle account for that too?
Okay, so for the oil crisis, Benner had forecasted good economic times in 1972 and then hard times in 1978. Now, the oil embargo hit in October of 73, remember? It caused this huge jump in oil prices. The global economy got totally shaken up, stock markets tanked, and the recovery, well, it took a while. It stretched into the mid-80s.
So again, his prediction of a shift from good times to hard times lines up pretty well with a major economic shock.
Yeah, the timing's not perfect, but the direction's there.
Okay, that's 2 for 2. Let's see if he can keep up this track record. What about more sudden, unexpected market crashes like Black Monday back in '87?
Black Monday, yeah, that was a wild one. A really rapid, severe drop. Now, Benner had actually predicted a crash in 1985, so a couple years off.
Still pretty close, though.
Yeah, it's pretty incredible. He basically saw a significant market correction happening in that general time period, and that alone is quite remarkable, don't you think?
I do. It makes you wonder, though, can these long-term cycles really pinpoint these short-term unpredictable events?
It's a good question. Maybe the real value is more in identifying those broader periods of vulnerability, the times when the market is more susceptible to shocks.
That makes sense. Okay, let's fast forward a bit. How did Benner's cycle align with the dot-com bubble and that whole boom and bust in the late 90s and early 2000s?
All right, so the dot-com era. Remember, it was all about those internet companies and stock prices skyrocketing. Well, it peaked around 2000. Then the bubble burst in 2002, and we had a recession. Now Benner's cycle had marked 1999 as a year of panic.
And looking back, there definitely was a lot of speculation going on back then. People pouring money into these internet companies, some of them not even making a profit.
Totally. Plus, there was that whole Y2K thing looming, everyone freaking out about computers crashing. So there was definitely this sense of market unease, right? And Benner had actually predicted 2005 as the low point, which is a bit later than the actual bottom, which was in 2002, 2003.
So again, not perfect timing, but he seems to capture the general direction of things.
He's got this knack for seeing these turning points, even if he doesn't nail them down to the exact year.
It's honestly pretty impressive.
Yeah.
Okay, last one on our historical tour. The financial crisis of 2007-2008. That one hit a lot of people hard.
For sure. That one was rooted in the collapse of the subprime mortgage market. Now get this. Benner's prediction for that period was 2007 as a year of prosperity and then a crash in 2012.
Interesting. I mean, 2007 did start out pretty strong, didn't it? The housing market was booming, the economy seemed to be doing well, and then boom.
Yeah, it was a pretty sharp turn. The crisis really started to unfold late in 2007, then it intensified throughout 2008. So Benner calling 2007 prosperous isn't totally off base, but that predicted crash year, that was a few years off.
So while his timing may not have been spot on, his cycle still pointed towards this major downturn happening sometime in the late 2000s.
Right. It's like he was picking up on those underlying conditions, those imbalances that were building up, even if he couldn't predict the exact moment when everything would come crashing down.
It's remarkable to me how these predictions from the 1800s have resonated with such major events across the 20th and 21st centuries. Our source mentions that Benner was a farmer, and he really understood the dynamics of crop supply and demand. I'm wondering how that might have influenced his thinking about the economy as a whole.
Oh, that's a really interesting point. I mean, think about it. Benner, he was out there working in the land. seeing firsthand how the cycle of planting and harvesting impacted crop prices. You have times of abundance, you have times of scarcity, and prices fluctuate accordingly. He probably saw those same dynamics playing out in the larger economy, right? Like periods of oversupply, or you could say over-optimism lead to price drops or market corrections, and vice versa.
So he was drawing these parallels between the natural rhythms he saw in agriculture and the patterns he observed in the markets.
Yeah, and don't forget, back then, farming was much more directly tied to the economy. Like a bad harvest could have ripple effects throughout society. So it makes sense that he would see these connections. Plus, a farmer deals with a lot of uncertainty. They can't control the weather, they can't always predict yields. So there's this inherent understanding of risk and the cyclical nature of things.
So it wasn't just these abstract financial concepts for him. It was grounded in his real-world experience. Okay, we've covered a lot of ground here. So if we were to distill some of the key themes from the Benner cycle, what would they be?
Well, first and foremost is the cyclical nature of markets. That's like the foundation of his whole theory. Benner was convinced that economic activity and market prices don't move in a straight line. There are these long-term patterns of expansion and contraction, booms and busts.
Like a wave, constantly rising and falling.
Exactly. And the second big theme is the impact of human psychology. Benner was adamant that these collective emotions, excessive optimism, fear, panic, they're not just side effects. They're actually driving these cycles. Think about it. When everyone's super optimistic, prices tend to get inflated, and then when fear kicks in, you get those panicked sell-offs.
So it's like our emotions are this hidden force shaping the markets, even if we don't always realize it.
Right. And then the third theme I think is crucial. It's the idea of opportunity within downturns. Remember, Benner saw hard times not only as periods of hardship, but also as chances to buy assets at lower prices, get ready for the next upswing.
It's the classic idea of buying when there's blood in the streets. But of course, it's easier said than done right.
Oh yeah, it takes a lot of discipline and courage to go against the herd mentality, but that's where the potential for big rewards lies.
These themes, the cyclicality, the role of psychology, and finding opportunity in downturns, those all seem incredibly relevant even today, wouldn't you say? I mean, even if we don't take Benner's specific predictions as gospel, there's a lot of wisdom there.
Absolutely. And I think understanding these themes can have a huge impact on how we approach investing. For example, if you embrace the idea that markets are cyclical, it can help you take a more long-term perspective. You're not going to get so caught up in the day-to-day fluctuations or those short-term market swings. You recognize that downturns are normal, they're going to happen, and they can even be opportunities.
So instead of panicking and selling everything when the market dips, you might see it as a chance to buy.
Right. It's like that Warren Buffett quote, "Be fearful when others are greedy and greedy when others are fearful." Benner was saying something very similar over 100 years ago.
That's fascinating. So it's not just about knowing when to buy and sell, it's about managing your own emotions, not getting swept up in the hype or the fear.
Exactly. And Benner's work also highlights the importance of just being aware of market sentiment. Like, if you can sense that optimism is getting out of control or pessimism is becoming extreme, it can inform your decisions.
It's like having this extra layer of insight. Okay, so we've explored Benner's ideas. We've seen how they played out historically. Where do we go from here? How can someone listening to this apply these insights to their own lives and their own financial decisions?
Well, first things first, it's important to remember that the Benner cycle, as fascinating as it is, it shouldn't be used as like your only tool for predicting market movements. The world is a lot more complex now than it was in Benner's time. We've got globalization, technology, all these interconnected factors that he couldn't have foreseen.
Right, so it's not about taking his predictions literally or trying to time the market perfectly based on his cycle.
Definitely not. But those underlying principles he identified, the cyclical nature of markets, the influence of human psychology, those are timeless.
Yeah.
They're still at work today.
So how can we use the Benner cycle in a practical way then?
I think it's a valuable long-term contextual tool. It reminds us that markets have always gone through these ups and downs, and they probably always will. And it encourages us to be more disciplined in our approach to investing.
So it's a framework for thinking about the markets, a way to keep our emotions in check and avoid those knee-jerk reactions.
Yeah. Maybe you're a little more cautious when everyone else is overly excited, and maybe you're a little bolder when fear is running rampant. It's about finding that balance.
That makes a lot of sense.
Yeah.
So to recap our deep dive into the Benner cycle, we've learned about Samuel Benner, a farmer from the 1800s who developed this fascinating model for predicting long-term economic cycles. He identified these three key phases: panic, good times and hard times. And while his predictions have been surprisingly accurate throughout history, the real value of his work lies in those timeless themes: cyclicality of markets, the powerful influence of human psychology, and the potential to find opportunity in downturns.
And by recognizing these patterns, by understanding the rhythms of the market, we can hopefully approach our own financial decisions with a bit more wisdom and a bit more peace of mind.
Well said. And on that note, we'd love to leave you with a final thought to ponder. Considering the cyclical nature of markets, highlighted by Binner's work, how might understanding these long-term patterns influence your perspective on what's happening in the economy right now? And what other seemingly unrelated fields might offer valuable insights into those recurring patterns that we see in the world around us? We'll leave you to mull that over. Thanks for joining us on this deep dive.